Good afternoon, everybody. My name is Howard Pressman, and I'm one of the partners here at Eganberger & Weiner. Thank you very much for spending part of your day with us. As the rest of us were spinning dreidels and anxiously awaiting Santa's arrival, the Republicans in Congress and the president were busy putting the final details on their signature tax reform bill known as the Tax Cut and Jobs Act. Most everyone has an opinion about this law, and while it is certainly rife with controversy, but whether you like it or not, the new tax law is certainly changing much about what we know about taxes and tax planning. So here to help us better understand this new law and how it will affect you is Marnette Myers, Director of Tax Administration for Frank & Company. If you have questions during the presentation for Marnette, there is on the right side of your screen a GoToMeeting panel. And in that panel, you'll find a little hand icon. If you go ahead and click on that hand icon, you'll be able to raise your hand and we'll get to you and make sure that we get an answer to your question. So without any further ado, I am going to go ahead and turn this over to Marnette. Welcome.
Hello, everybody. Well, I know you're all excited to learn about the new tax cuts that are hopefully coming your way, and I hope that you are some of the lucky ones who are actually getting a break. When I did my tax projection, I am not lucky, so I'm hoping I'm speaking to many other lucky people out there. But as I'm sure you know, the Tax Cuts and Jobs Act was signed into law on December 22nd. As Howard mentioned, while we were all waiting for our holiday gifts, this was a gift given by the government. For the most part, this really applies to your 2018 taxes and forward, but it's not permanent. Everything goes away in 2025. There is one little blurb that is retroactive, and that's your medical expenses. So I'll touch on that a little bit. That actually went back to 2017. So we do have a little, I guess, gift for 2017 as well. The Tax Cuts and Jobs Act is projected to reduce taxes for 95% of taxpayers. Like I said, I'm planning to have a little club of the 5%ers, and we can all get together and talk about how we pay more taxes. But for the most part, this does seem to be reducing taxes, at least somewhat, for most people out there. Okay, so the big changes, let's see if our little slide goes forward here. Oh, there we go. Okay, so before the Tax Cuts and Jobs Act was introduced, 2018 was projected to have 7 tax brackets. The tops going from 10% to 39.6%, the same old tax brackets that we've now had for years and everybody had grown accustomed to, and I hopefully loved. The top tax bracket at that point for single filers went up to start at 426. We'll say 427,000, and $480,000 for married filers. Now you'll notice that the married filing jointly bracket is not double the single bracket. If it was, that would be close to 950,000. And that's one of the things they look at when they talk about the marriage penalty. The marriage penalty previously started in the 25% tax bracket. That bracket ended at 93,000 for single taxpayers and 156,000 for married filing jointly. So for the most part, if you had 2 fairly well earning individuals married, they were most likely going to pay a little bit more than if they had been single filing as a single person, not taking into account anything else. This is purely just on the tax brackets themselves. There are clearly some other benefits to married filing jointly as opposed to married filing separately. So it's just looking at the tax brackets themselves, and have to make sure you don't trip over any one of the other little problems that married filing separately can throw at you that you're not expecting. So let's look at the 2018 tax brackets as they were enacted in the new tax bill. So hopefully you can see here that the marriage penalty is really gone until you hit about $400,000. So through the 32% tax bracket, there's no marriage penalty just based on the tax brackets themselves. You'll see that this individual bracket at 32% ends at $200,000, and for married filing jointly, it ends at $400,000. So exactly double. However, when you get to the 35% bracket, you'll notice that for a single person, that bracket ends at $500,000. But if you're married and you file jointly, that's $600,000, which is quite a bit short than the $1 million it would need to be to avoid the marriage penalty. Again, not the only issue with married filing jointly versus separately, but it is something to consider. And as part of your tax planning, you usually should at least look into the idea of whether married filing separately or jointly is better for you. I do a calculation for all of my clients, and we look at that every year. I just did one, I think, last night, and it literally was a $1 difference. So sometimes it's no difference, and then I did one 2 days ago. It was an $8,000 difference. Can swing very much, so it's something to always keep track of, and it can change from year to year. So it's certainly something you want to keep track of and watch out for. So while we're going over the easy things, we'll get into a little more of the difficult new tax changes that we have coming up. So I'm sure you've heard a little bit of information on the standard deduction changing. The standard deduction rates have gone up greatly under the new tax bill. You can see here for single, it went from $6,500, which was the projected 2018 number, to $12,000. Married filing jointly is $24,000. You'll notice exactly double there. So once again, getting rid of any kind of marriage penalty. The thing to remember, however, is that you're losing a personal exemption under this new tax bill. So if you were single under the previous bill, your standard deduction was $6,500. You also had a personal exemption of $4,150. So you're at $10,600. Under the new tax bill, you're just getting an additional $1,400. It's not as great as it sounded when it first came out. It's not a $5,500 increase. It's barely $1,400. So that's just another thing to watch out for. I do have a lot of clients that now are looking at the fact that they're not going to be filing using the itemized deductions anymore because of the $24,000 level for the standard deduction. We'll get into that a little bit later, but it's certainly something to be wary of and watch out for your own. And I'll give you one of my little tips for what to do if you are in the standard deduction world now under the new thing. It's not a huge tax planning gain, but every little bit helps. So we'll go on to the next. We already talked about the personal exemption. So here's something that's unusual. It's not implied, it doesn't apply to 2017. It actually comes into account in 2019, and this is alimony. Under the current alimony rules, the paying party gets a deduction for the amount paid to the recipient. So if I was paying out $100,000 a year in alimony, which would be, there's no way that could happen because I don't have that kind of money, but let's pretend I do. would get to deduct on my taxes $100,000, and the recipient of the alimony would take into income $100,000 in their return. This only applies to alimony. So child support does not apply at all in this situation. So under the new rules, again, and this is only for agreements dated after 12/31/18 or January 1st, 2019, alimony is no longer a deduction for the paying party. So they will not get to reduce their taxes by this mythical $100,000 that I was paying out. And the recipient would not get the $100,000 of income either. So I guess the moral of the story is if you want the deduction, you should have your divorce settlement before December 31st, 2018. And really the reason they put this into play is because generally the alimony paying party is in a higher tax bracket than the recipient. So the whole reason you're getting alimony to the recipients because they're in a generally a lower tax bracket. So this allowed the shifting of tax basis to go from a higher paying party to a lower paying party, the recipient. So this helps keep more money in the government coffers by having the higher tax bracket party pay more in income tax. So again, as long as you got divorced and the settlement agreement was prior to 12/31/18, the old rules apply. Paying party takes the deduction, recipient puts the money in his taxable income. After 1/1/19, the rules change. And this alimony rule has been in place for quite some time, so this is definitely a change for everybody to watch out for. Now, the one I'm sure you've heard most about is the state and local tax deductions, or SALT, as we in the biz like to call it. You can't just deduct everything you pay anymore. It has a ceiling of $10,000. Now, SALT includes your state income taxes, your real estate taxes, and for those of you who live here in Virginia, personal property taxes or your car taxes. That entire basket of deductions cannot exceed $10,000 now. So this is probably the biggest part of the reason why a lot of married couples will no longer be filing with their itemized deductions. If you don't have a mortgage, you don't have mortgage interest deduction, and under the new law, all you have is $10,000 of SALT deductions, and that leaves you with $14,000 of other deductions before you'd ever get to itemize. If you don't have a mortgage deduction and you don't give more than $14,000 in charity or have medical expense deductions, you don't have enough to itemize. So this gets you to the point where your $24,000 is much better than your $10,000 plus, let's say you only give $4,000 to charity. So you're at the $14,000 level. Clearly, you're going to take the standard deduction going forward. Now, if you have a mortgage, you're most likely still going to be able to itemize. Once you factor in mortgage interest, $10,000 of state and local taxes, your charity, most times that's going to come out to about $24,000, but sometimes not. So definitely something to keep track of and watch out for. Clearly, taking a standard deductions really reduces the amount of information you have to collect and stay on top of for your taxes. I'm sure everybody likes less record keeping. I know I do, but you don't want to leave deductions on the table if you're able to itemize. So just keep track of that. This isn't the only change in the itemized deduction world. There are more coming, and I will get to them in just a minute. So in the beginning, we talked about medical expenses, and I said medical expenses were one of the few things that were retroactive to 2017 that the new tax bill changed. And what it changed was that previously, 2017, if you were under age 65, your medical expense deductions had to exceed 10% of your overall AGI before you can deduct them on your Schedule A itemized deductions. What I usually tell my clients, and I guess random people I just talked to on the street that want to know about their taxes, is that you generally don't want to have to deduct your medical expenses. It means one of two things. You had a very bad year medically, or you had a very bad year income-wise. So it's not really something to aspire to, deduct your medical expenses, but if it's there, you certainly want to take advantage of it. So for 2017 and 2018 only, your medical expense limitation is 7.5% of your AGI. So if I made $100,000 as my adjusted gross income, if my medical expenses exceeded $7,500, I would get to deduct that excess. So if I had $10,000 of medical expenses, I could deduct $2,500 on my tax return.
Hey, Marnette.
Sure.
Hi, this is Howard. What about medical insurance premiums, perhaps even long-term care insurance premiums? Would those count towards the 7.5% of AGI?
That they do. And what I do find is a lot of times once my clients have retired, the medical expense deduction comes into play because you're no longer paying your medical insurance premiums with pre-tax money. When you're employed, most that comes out pre-tax, which means you don't get to deduct your health insurance premiums. But if you're paying health insurance premiums with post-tax dollars, like let's say when you have your Medicare premiums withheld for Social Security, that's post-tax dollars, so that counts. Long-term care insurance premiums do count as health insurance premiums, but the full amount may not be deductible. It depends on your age. There is an age, basically a limitation for each age grouping as to what can be deductible. And so that's something you definitely want to keep track of. Here in Virginia, where I am, even if you can't deduct long-term care insurance as medical expenses because you don't have enough medical expenses, the state of Virginia does give you a deduction for long-term care insurance. So other states do as well, so that's also something to watch out for. It's not everything is federal based. Clearly, we like to look at the state as well because that matters too. One other thing to watch out for medical expenses and health insurance premiums specifically is if you're self-employed. If you're self-employed, your health insurance premiums, including dental, long-term care, again, subject to the limitations, can be deducted on the front page of your return as self-employed health insurance. So if you have your own business, you're a Schedule C, or you're a partner in a law firm, let's say, that's organized as a partnership, that's where your health insurance premiums go. They don't go into the basket that goes on Schedule A, and you don't have to worry about the 7.5% AGI just for the premiums themselves. So that's another thing that can pop into play for medical expenses to watch out for.
Great, thank you.
Absolutely. And please, yeah, ask questions along the way. Nobody wants to hear me drone on for the next 45 minutes, I'm sure. Okay, let's see. Oh, we're not moving. Let's try again. Oh, there we go. Okay, so the child tax credit. And this is where I'm seeing the biggest benefit to a lot of my clients. Previously, the child tax credit you couldn't get if you were married filing jointly if you made more than $110,000. That's not a very high threshold. If you were single, it was $75,000. You'll notice it wasn't quite the double there for the single to married filing joint, so that was one of the little marriage penalty kickers in there. In the new tax bill, not only do they increase the child tax credit to $2,000 a child, which is up from $1,000, they increase the phase out, which means a lot more people are going to get this deduction. So we went from married filing jointly of $110,000 limitation to $400,000. So that opens this credit up to so many more people. And this is where I'm seeing the majority of my clients getting the biggest boost. Well, my clients who aren't making huge amounts of money in the 39.6% tax bracket. This is where I'm seeing the biggest benefit for a lot of my clients who have, kids, let's say in middle school, they've got 2 jobs, we're easily making $110,000, but now, so they weren't getting this. That was $2,000 of tax credits, dollar for dollar reduction in your taxes. Credits are always better than deductions. So now, let's say they're making $350,000. Now they're getting, and they've got 2 kids, they've got a $4,000 tax credit just because of this that they weren't getting under the previous tax law. So this is what I'm seeing as the biggest boon for a lot of my clients. So this is certainly helpful on a personal level. Of course, my family makes me do their tax returns because why not? So for the past 4 years, I've made my sister and brother-in-law file separately for tax purposes solely because of the child tax credit. When they filed jointly, their income was too high and they could not get the child tax credit. When I file them separately, because one makes a decent amount lower than the other, they could get the child tax credit at that point. So again, it's another thing to look out for in the married filing jointly versus separately thing. So they were able to get the child tax credit this way. Previously, under the new tax law, they can finally file jointly again, and I can stop explaining to them that just because you file separately doesn't mean you're not married and everything is still fine. So it took a lot of convincing, but they were happy to save. They saved, I think, $1,500 doing it that way in the past. Going forward, don't have to do it. Will make my life much easier, and I guess we can go back to being good family again. So the child tax credit does only apply to children that are 17, basically under 17, and you attain the age of 17 basically the day before your birthday. So it's a weird little rule in the IRS world. Now, if you have a dependent child that's 17 or over, kids in college, senior in high school, they're not eligible for the child tax credit. So that $2,000 is out the window. And if you remember, we don't have the personal exemption anymore because you lost the $4,100 that you used to get for having them as a dependent. So what did the tax law decide to do? They made what they call a family credit. And this applies to dependents 17 and older. They can get a $500 credit. This credit is non-refundable, unlike the child tax credit, which you can is refundable up to the point of $1,400. So this is, $500 again, tax credit, dollar for dollar reduction in your taxes. Great, you certainly want to take advantage. but it doesn't quite even out generally to losing the $4,000 personal exemption for a $500 tax credit. If you're in the 33% tax bracket, this is not a better deal than what you had under the previous tax law. But that's not law anymore, so we don't really have a choice. Oh, and just to note, that does apply. They don't have to be your child to get that family credit. That's why it's called family. So if you have a parent that you claim as a dependent, that $500 is still available for that credit for a non-child dependent. But you do have to be careful of the dependency rules and make sure you are following those specifically. So here's another fun change that we have here. So the mortgage interest deduction. There was a lot of debate on where the Congress was going to go with mortgage interest deduction. There was, they were going to limit it to just one house. They were going to limit it to 500, 1 million, keep it a million, all over the board. They finally came down to this. So interest is only deductible on $750,000 of acquisition indebtedness. Now, acquisition indebtedness includes clearly purchasing your house. It also includes improvements to your house. So if that includes doing redoing your kitchen, renovating the basement, any kind of thing like that. So that goes into acquisition indebtedness too. So $750,000, this is only for loans that are entered into after December 15th of 2017. So it does eke into 2017 a little bit, but there aren't that many loans that close between the 15th and 31st of December. So if this is a new house you're buying, $750,000 of debt. It can apply to more than one house. You can have two houses, your primary residence and your second, but in total, you'd be limited to the $750,000 limit. If your debt was incurred prior to December 15th, you still have the $1 million limitation that was I guess that's been around for at least 20 years, I do believe. So that still goes back to the 1 million you're grandfathered in. If you bought your house in 2015 and you have $1 million debt, you can completely deduct all of that interest. If you go over that interest, say your old debt was 1.4 million, you do have to do a pro rata calculation to limit that debt. So you only get, I can't do that math in my head, but 1 million divided by 1.4, whatever that percentage is, times your interest. And that's the most amount that you can deduct in that year. Clearly, you do the calculation every year, figure out what the average debt is, and go forward. Now, the kicker that what I've heard a lot about is home equity loans. The interest on home equity loans are no longer deductible. Now, personally, this made me really worried because as this came out, I was just in the process of applying for a home equity loan because I was redoing my kitchen. I got very nervous and I didn't want to lose the interest on this home equity loan that had always been deductible for so many years. But if you remember, as I said earlier, acquisition indebtedness includes renovating your house, redoing your kitchen, redoing the basement. By the way, we're on month 3 of my kitchen. It's not done yet and it's been dragging on way too long, but I think we're almost done. So renovating your kitchen is considered acquisition indebtedness. So even though I have a home equity loan, it's not disbarred by the new tax law changes. That is included, goes into the whole $1 million limit because I actually did get it in place before December 15th. So it goes into, I look at the debt on my primary mortgage, my home equity loan. As long as that's less than $1 million, I can deduct it because I used those funds to improve my home. Under the old law, what they call home equity loans, you were allowed to take $100,000 out of equity of your house and use it willy-nilly for whatever you wanted. You could buy yourself a $100,000 new car. You could go on a fancy vacation. You could do anything like that and still deduct the interest as mortgage interest as long as the debt didn't go over $100,000. That's what the new law got rid of. So even though I have a home equity loan, I use the money to renovate my house, I can still deduct that. Now, if 5 years ago you took out a $100,000 home equity loan to go on the vacation of your lifetime, round the world trip, whatever you want, you saw everything there is to see, that interest, even though it's been deductible for the last 5 years, is no longer deductible starting on your 2018 taxes. You have to look at what were the funds used for, and that will determine whether it's deductible or not. Even if it's a mortgage interest, say you refi your house and your debt had been $500,000, you took it up to $700,000, and you went around the world twice with that extra $200,000. That $200,000 of the debt, the interest related to that, is not deductible and never has been. So that doesn't change. So these are what are called the interest tracing rules. So you do have to look to see what the interest or the loan was used for. So just be careful about that. Even though your debt deduction's been allowed for the last 10 years, watch out and see what you actually use the funds for and keep track of that. So that one I've seen tripping up a few people. So let's talk about miscellaneous itemized deductions. These are completely going away. Miscellaneous itemized deductions were towards the bottom of your Schedule A in the whole almost kitchen sink variety. And they had to exceed 2% of your AGI before you could deduct those. So this is the one that hits me the hardest. Tax preparation fees, they're gone. They are no longer deductible for your personal tax return preparation. If you do have tax prep fees for a business or a partnership or anything like that, those are still deductible. It's only the personal ones that are gone. Something else that, investment advisory fees, those are gone as well. Those used to be a 2% miscellaneous itemized deduction. Gone. We had, let's see, union dues. Those are gone. Unreimbursed employee business expenses. Those are also gone. Although, honestly, you should be able to get your employer to reimburse you, so you don't even have to worry about it. Casualty and theft losses, gone. It's not something you see very often, and they did allow that if it is in a presidentially declared disaster area, those are still deductible. So that's a positive. You also had safe deposit box fees, not deductible anymore. Now, moving expenses, which were not an itemized deduction, they were on the front part of your return. It used to be if you moved essentially more than 100 miles for a job, has to be for a job, you could deduct moving expenses. That deduction, as of 12/31/17, is no longer allowed unless you're a member of the armed forces. Now, as a member of the armed forces, many times, most of your moving expenses are paid, but they still do allow for the ones that weren't reimbursed. So that deduction is still allowed. And here's one that I've been seeing a lot of: employer subsidized parking and transportation reimbursement. Here in the DC area, we see a lot of that where an employer will subsidize your parking or metro transportation, things like that. So the point that the employer provides this, that is no longer allowed. The employer can't take a deduction for it anymore. If your employer is a nonprofit, they're potentially hit with tax on this, which not too often do you see a tax exempt organization hit with tax, but it can happen. And this is one of them. Employees can still pay pre-tax into a transportation plan, but it has to be an employee payment. The employer side is gone as of 2018. Well, at least until 2025, when everything goes away and we start anew, unless everybody extends everything. One other thing I used to see a lot of is itemized deductions were being phased out. So if you made a certain income level, you lost 3% for every $3,000 it was that your income was over this threshold. It could never eliminate more than 20% of your itemized deductions, but it was still a big hit. That is completely gone. So even if you made $1 million, you get every one of your remaining itemized deductions that are allowed. Now, there's not much allowed anymore other than $10,000 of SALT, medical expenses over 7.5% of your AGI, mortgage interest, and charity. That's about all that's left. So there's not a lot left, but none of them will be phased out anymore. So that's something that's new and everybody seems to be quite happy about. Okay, so next we have charitable contributions. There was a lot of talk about what was happening with charitable contributions as well. they really didn't change much, honestly. It used to be you could deduct a charitable contribution to the extent as long as it wasn't more than 50% of your overall income. If it was over 50%, it just rolls over to the next year and it goes into a pot that keeps going until you pass away, then it goes away. They changed that so you can deduct up to 60% of your AGI in charitable contributions going forward. Not a big change. What you've probably heard a lot about is that charities are concerned that they are not going to get as much money anymore. And why they're concerned is because so many people are going to move to the standard deduction, $24,000 for married filing jointly. So here's where I said earlier I would give you just a little tax tip if you're getting into the married filing jointly standard deduction world. So I have a lot of clients, they've paid off their mortgage. All they have is, state and local tax deductions, $10,000, and charity, essentially. They don't qualify for medical. And as we know, pretty much everything else is gone. So a lot of times they're fairly charitable. Maybe they're giving $10,000 to $12,000 to charity, but if they only have the SALT deduction, that's still only $22,000. Standard deduction is better at $24,000. So what I've been telling them is instead of being charitable every year, you be charitable every other year and you double up in the year that you're charitable. So under my example where I usually give $12,000 to charity, instead of giving $12,000 to charity, let's say in 2018, I give nothing. I do my 10, maybe a little bit, here and there, but essentially nothing. So I take my $24,000 standard deduction and go about my business in 2018. Now in 2019, I'm going to be very charitable. I'm giving my $12,000 that I would have given in 2018 plus $12,000 that I normally give in 2019. I'm taking $24,000 of charity in 2019. Add that to my $10,000 of state and local tax deduction, and I'm at $34,000. Higher than the standard deduction, I'm itemizing in that year. So what I've done, if I had so $34,000 in year 2019, $24,000 in 2018 from the standard deduction. So if I can do math, and sometimes I can, I believe that's $58,000. Now, if I had just gone about my business, giving my $12,000 in 2018, $12,000 in 2019, where I take the standard deduction both years, I would take $24,000 in 2018 and $24,000 in 2019 as my standard deduction, or total deductions of $48,000. When I double up my charity in 2019, my total deductions for 2018 and 2019 combined were $58,000. I have just bought myself $10,000 of additional deductions that I get to take on my tax return, and I haven't spent any more money than I would have normally. So again, it's not a great tax savings, but if you're in the, let's say, the 22% tax bracket, you've just saved yourself $2,200 using this charity every other year world, and you're not out any other money out of your pocket than you would normally have been. So I think that is a small tax savings, but it's still, I'll take $2,200, and that just looks at the Fed. You get some deduction on the state too. So I think that's a win. What I do tell clients is if there is a charity that they normally give to, a lot of times that's their church or, favorite charity, let them know if you're going to do this so you don't just out of the blue stop giving to them one year and that, perhaps they had budgeted for your donation. So just give them a heads up. I mean, you can do the charity from, in say, 2 days apart, as long as one's December 31st and one is January 1st, those are, close in time. You could, give, if you were going to do when you normally would give in 2018, say you give that on January 1st of 2019, it's not that far. And then the next one you could do December 31st of 2019, and you're still very close. You haven't messed them up too much as far as their budgeting, but just kind of give them a heads up if it's your favorite charity or one you work with a lot. But that's a small little tip that you can all take home, and hopefully that can work out for you. So we'll move away from the charity world, and we'll go to 529 plans. 529 plans, as I'm sure you're aware, help you save for college. You do get a deduction generally on your state return. This is not a federal deduction. So it is a nice way to help build up savings for college. Depending on what state you're in, the limits are different in every state. Every state has different rules as to which plans you can invest in. For example, Virginia only allows Virginia plans. Some states allow you to go in any state, or maybe just local, states close by you can invest in. So make sure you check your state rules and get that in play there. But generally, 529 plan distributions, when the money comes out, if it was used for qualified education expenses, which is pretty broadly defined, that money comes out tax-free. So if the money was put in, let's say in 2005, say you put in $2,000 in 2005, and it's worth $20,000 right now, great return. You take that $20,000 out for qualified education expenses, none of that $18,000 increase ever gets taxed. Nice little tax savings plan there. So it used to just be for higher education, so post-secondary. The new tax bill has opened this up for K through 12 tuition up to $10,000 per child annually. Now there's some trade-offs with this. Clearly, if you're taking the money out now for K through 12, there's less funds available for college, so you have to watch out for that. This does not apply to any homeschooling educational expenses. The original bill did extend this out to homeschooling, but there was some technical issue with the bill. They had to resubmit and make a change, and the bill that was ultimately signed did not include homeschooling. So no homeschooling expenses count. It does say that you can include public school tuition, but I'm not really sure what public school tuition is, because I believe that's the whole idea of public school, is it is not tuition related. But it does actually say public, and it counts for religious schools as well, and any other private school. So, that's a new change there that seems to have some impact that people are looking forward to. But just remember, taking the money out now, clearly it's less tax deferred and less is available for college. So watch out for that one. The next thing I hope you guys don't know about is the alternative minimum tax, and hopefully you're not impacted by it, but I'm going to guess a good portion of you are, because AMT, which was meant to only hit the richest of the rich when it was first envisioned, does not hit the richest of the rich. In fact, they rarely hit AMT. It hits middle class Americans for the most part. Now, the new tax bill does change a little bit of the AMT rules. It changes the phase out numbers and some things like that. But the biggest thing is most people are not going to be hit by AMT anymore at all. And the reason for that is because SALT, your state and local tax deduction, was the biggest add back to calculate your alternative minimum tax. Biggest one for everyone. Now you can't deduct all your state and local taxes anymore. You're limited to $10,000. So that add back, which for a lot of people was, up to almost $100,000, is at $10,000. That's nothing at this point. So virtually nobody is going to be hit by AMT unless really there's a stock option situation. That's still around. That is still an AMT adjustment, and I think that's the only time we're really going to see AMT hit taxpayers anymore. The one thing I don't know is how this is going to impact taxpayers who are eligible for a credit for AMT that was paid in prior years. Haven't really been able to work through all the calculations on that to see if really anybody's going to be able to get that credit for prior year AMT that was paid, which in and of itself was always a rare thing to happen, but it did happen from time to time. So we'll have to wait and see what really happens there. But just take heart and take heed that hopefully you will not hit AMT ever again. And that is also a nice little tax savings. So here is something that is actually, I won't say wrong, but we just got final definitive information from the IRS on Monday, actually. On March 5th, they put out Revenue Procedure 2018-18. And that's the procedure that calculates all the inflation adjustments that figures out what's the, what are the tax tables going to be for the next year and all that good stuff. So 2018-18 came out and it recalculated all of the items for 2018 under the new tax bill. And the only one that I really noticed that was a big change was the estate tax exemption. Now we had, and as I say in the slide, it was projected to be 11.2. That's because we didn't know yet what it was really going to be, because the new tax law changed the inflation adjustment calculations and a whole host of other things. So the IRS on Monday issued 2018-18, and it said that the estate tax exemption for 2018 is going to be $11,180,000. So $20,000 less than we have on here. And then under portability, a married couple could actually save up to $22,360,000. So, $40,000, not all that much different than we had before, but it is a little less. That will get adjusted for inflation every year. So that will go up again, most likely in 2019 by a bit. So just something to kind of watch out for there. And then we have the gift tax exclusion. This really had nothing to do with the new tax law, but I just throw it in there because I like to tell my parents how much money every year they can give me without having to file a gift tax return. So that exclusion for 2018 is $15,000. That's up from $14,000 in 2017. So married couple that splits a gift, they can give $30,000 per recipient in 2018. There are no gift tax issues at that point. If it's $40,000, let's say, then they will have to file a gift tax return, which means it would eat into that $11,180,000 per person that they have. So this new estate exemption is really, I think, changed the playing field for these things. I remember not that long ago when the estate exemption was $650,000. That's not that much. And that, well, I hope wasn't all that long ago, because that would mean I'm getting very old, was really within the last 10 years that has really jumped, let's say from 650 to 11.2, which means, estate tax planning is not nearly as complicated as it used to be. There's still a lot of good reasons for estate planning and putting, some things in place, but it is less, I guess, dire in this point. Between a married couple, $22 million is a pretty substantial amount. Clearly, you still want to make sure that you're protecting that $22 million as much as you can, but just another thing to keep in your mind. Another thing, which isn't in the slides here, but just wanted to let you know, the IRS on February 28th finally came out with the new W-4 that incorporates the new tax bill. So if you have withholdings on a W-2, you may have noticed that under the new tax bill, in about mid-February, your withholdings went down. So the IRS did issue the W-4, so you can recalculate. Maybe you don't want to do married filing jointly with 2 exemptions anymore. Maybe based on your projections for 2018, you think you need to drop to married filing jointly with 1 exemption. You can actually do that calculation now. The IRS also has an income tax withholding calculator on their website, which I will say is not the easiest thing to use, but it is better than nothing. So what I wanted to kind of let you know is I ran some numbers, just hypothetical numbers, to kind of give you an idea of withholdings that are changing for people. So I've got 2 different scenarios. So in scenario 1, I have a married couple. They had, let's just pretend they had only one check. Let's make the wife. She made $150,000 a year. The husband did not. So previously they were doing married filing jointly with 2 exemptions for her withholding. So in 2017, her withholdings for the year, and I pretended that she got paid semi-monthly because why not? Her total federal tax withholdings were about $23,800. Under the new tax bill, with the new withholding tables that the IRS did put out in late January, her total withholdings for the year, assuming that they were the same all year, were $19,600. So she was looking at a $4,000 reduction in her federal tax withholdings. Now, so long as her taxes were going down by at least $4,000 in 2018, she'll be okay. But that's something that you really need to watch out for, because when you're doing your estimates for 2018, you have to factor in that your withholdings are probably going to go down. in scenario number 2, oh, and just so you know, that married filing jointly couple under the new tax bill went from the 25% tax bracket to the 22% tax bracket. So their marginal rate went down by 3%. In scenario 2, I said we had a single person who made $300,000 a year and got paid bi-weekly. Under the 2017 tax withholdings, they would have had about $79,000 withheld from their paycheck during the year. Under the new withholdings, they're $76,500. So they're having $2,500 less withheld during the year than they did under the old rules. And the thing this person needs to watch out for is under the new tax bill, they went from 33% marginal tax bracket to the 35% tax bracket. So their tax bracket actually went up. And if they have less taxes withheld, they could be in for a rude awakening come April 2019 when they finish their taxes. So they're in a higher tax bracket and they have less withheld. So clearly they are somebody who needs to be watching out for some issues like this. And one thing I see a lot with my clients, and I'm sure some of you experience this as well, is a lot of their pay comes through a bonus. So say you've got a $100,000 base salary and whatever else you make is a bonus that you get, let's say, once a year in December. So when you get paid like that, that bonus payroll is not withheld at your normal pay rate, where you say that I'm single, I have one exemption, withhold me at that, whatever that percentage is. That is a flat rate of 22% under the new tax bill. So if my $300,000 person got paid $100,000 base salary throughout the year, but $200,000 as a bonus at the end, that bonus is only going to be held at 22%, and they're in the 35% tax bracket. So they're looking at a shortfall of taxes when they go, come April. So that is a huge issue to watch out for, especially if you're getting paid in the bonus world. Now, if your bonus is large enough, I believe if your bonus is over $1 million, they will withhold you at 37%. So you don't have to worry about that quite as much. But personally, I haven't come across with too many. Personally, I've never come across a bonus where someone wanted to pay me $1 million. But you don't see that too often except in very large corporations. So that kind of covers the basic changes in the tax law. And I haven't gone into any of the business changes, for partnerships, flow-through corporations, C corporations, which is a whole nother world of repatriation from overseas. We have so many other things to talk about, but we wanted to kind of keep this focused on personal since this is what most of you are going to be looking at. But I would love to hear if you have any questions or anything you want to delve into further.
Yeah, we do have, let's see here. We've got a question from Gary. So Gary, I have unmuted your line and go ahead and ask your question, Gary. Gary, do we have you?
No, you don't.
Oh, I hear you there, Gary.
Oh, could you hear me?
Yes, sir.
Oh, okay. I don't have a microphone plugged in. I guess there's one built in at this computer I'm using.
I thought Gary was afraid of me.
Oh, don't worry. PMI and points and things like that on mortgages. I'm not even sure they were deductible in 17, but what about under the new law?
I do believe the PMI has gone away. I'm not 100% sure on that. Points, I believe, are still deductible. Now, what you have to watch out for is if this is a purchase. When you purchase your principal residence, points were deductible as long as they were paid to reduce the interest rate. Points were assumed to be essentially prepaid interest. Now, if you refi, points are amortizable over the life of the loan. If it was points paid on a second home, those were never deductible. They were also amortized over the life of the loan. To my knowledge, that has not gone away, but I'm pretty sure PMI did, and I think I've seen about 2 people that were actually able to deduct the PMI. Was one of the things I harped at my clients the most that had PMI. I'm like, get out of PMI. You have equity in your house. It's time to refinance.
Okay, thanks.
Okay, thank you. All right. If you have any questions, remember the hand icon in the panel on the right side of your screen, and I will give you a call when we get there. I think, let's see. All right. Willard, I have unmuted you. Go ahead and ask your question.
This is Tina, Willard's wife. I have a question.
Hi, Tina.
Hi, I'm really enjoying this and getting a lot of good information. I have a question regarding standard deductions, charitable deductions.
Sure.
I had read that if you take the standard deduction in 2018, that you could make a charitable contribution from your IRA. And what would happen is you would ask the people who manage your IRA to issue a check directly to, for instance, your church. And then you could go ahead and deduct that amount as well as the standard deduction.
Well, you're kind of right there. Now, what happens is that's a qualifying charitable distribution coming from your IRA. And I believe it is limited to your required minimum distribution amount. It can't be more than that.
Right.
So what happens is you don't get the deduction as a charitable contribution. But what it does is it reduces your overall taxable income because your distribution isn't completely taxed. So let's say you had a $10,000 distribution and you wanted $5,000 to go to your church. Normally that $10,000 would be completely included in your taxable income. You take an itemized deduction for $5,000, and that's how you would move on with your life. Under the qualifying charitable distribution, the QCD, instead of putting $10,000 as income to you, only $5,000 gets reported as income. The other $5,000 doesn't come into play. You don't get a deduction for it as an itemized deduction, but you've only included $5,000 as income instead of the $10,000 that you normally would.
Oh, okay.
So it works. It gets you to the same place, but
Mm-hmm. Okay, thank you.
Sure.
All right, that was a great question. Thank you. All right, let's see. Do we have any other questions? Last call for questions. Let's see. All right, Dan, I have unmuted you.
As a follow-up to the previous question, does that charitable distribution apply to inherited IRAs?
Does the charitable qualified charitable distribution apply to inherited IRAs?
No, I do not believe it does. This is only from an RMD from a regular IRA.
Okay.
And one thing to keep in mind for the qualifying charitable distribution, you do still have to get a receipt from the charity showing that they got the money. Even though you're not going to deduct it as an itemized deduction, you do still have to have a contemporaneous written acknowledgement, as they call it in the IRS world. So you do still need that should anyone ever ask. So just make sure you also get a copy of that for your files.
All right, very good. All right, well, there doesn't look like there are any additional questions. If you would like additional information, here is contact information for both Marnette and, of course, us. Additionally, we have two really good pieces on our website, EBWLLC.com, and then on the top right, you'll find the Knowledge Center, where we have one specifically on charitable contributions under the new tax law, as well as just a general overview of the new tax law. Both of those are on our website. Marnette, thank you so much. There's a lot of great information there, and I know you're really, really busy at this time of year.
No. Tax time is nothing for us.
I think I know different. So yeah, it is very generous of you to take time out of this busy schedule. Good luck with your kitchen renovations too. I hope that all comes out.
I'm very excited to start cooking again.
Yeah, that'll be great. All right, and everybody, thank you for joining us for our webinar. We appreciate your time and attention. As always, if you have any questions on how this new tax law or anything else affects your planning or your goals, please feel free to reach out to your financial planner. We're always happy to talk with you. And if your family or friends have any questions, we're certainly happy to talk with them as well. In the future, we're going to have our next webinar, which will be on long-term care options. So stay tuned for more information about that. And everybody have a wonderful day, and I'll look forward to talking with you all soon. Thank you again.